Hello, everybody. My name is Sumit Garg, and I'm ex-founder of Threadbar. I thought of doing this short video on startup valuation, basic concepts for entrepreneurs and founders, mainly because I have a lot of friends and acquaintances who have been asking me about how I did the evaluation when I started my startup and how what has been my experience in terms of how the other investors or the VCs, they are doing the valuations as far as the startups are concerned. So I thought of doing this specific video mainly to cover the basic concepts uh, around finance and concepts related to financial analysis. So here is the agenda. Uh, I'll be doing a short overview on the startup valuation. Then I'll cover the different valuation models which are being taken up by different investors. Then I'll cover some of the basic concepts of financial analysis. And lastly, I'll go through the Excel sheet, which I have created for a hypothetical startup and doing the calculations in terms uh, of arriving at a final valuation for a specific startup. So here is the a very high level overview in terms of the startup. So usually the founders or entrepreneurs are very passionate on the product or services which either they are working upon or they are innovating or which they are trying to bring to the market, and very often they have very little knowledge or background in finance. Now, what over here is very important is that as a founder or as an entrepreneur, you should have a complete knowledge of the market or the market size, the competition, development cost. All these information is very important, especially when you're going to any investor or a VC or anyone like that. Now, one of the major important challenges when you're doing a valuation for a startup is that it is very difficult to value a startup business, mainly because there is no historical data on the revenue or sales or the expenses, operating expenses, and all the other kind of figures which are important while you try to value a specific business. Um, Another a big challenge with the startup valuation is that sometimes, or most of the times actually, startups have a very new or a very innovative idea which hasn't been made commercial yet. So sometimes not only just the founders or the entrepreneurs, they face that challenge, but it is also the investors. They also face the challenge in terms of valuing those startup. So that's the reason, which brings me back to the second point, that it's very important for the founders and the entrepreneurs to have a complete knowledge of the market, competition, and other related costs. Uh, the other major important point is that the future potential of your business or of your startup or any new product or service which you are building on is dependent on many assumptions, and they range from your own expertise, your own experience, the any specific technical supremacy you have, like patents and other things. So there are a lot of other factors which are important while doing any kind of evaluation. And the last and the important point is that it is not only just the quantitative evaluation, it is also a qualitative evaluation of the startup which plays an important part. And also, while the investors or the VCs or angels or anyone who's trying to value your business, they also take into account these qualitative factors as well. So coming to some of the main valuation models, so I've taken this from investopedia.com. There are a whole lot of other valuation models or approaches which are there, which are taken by different investors. But I'll cover these four major approaches. And this particular session covers the discounted cash flow approach. But as an investor or as a founder, it is very important that you are aware of these four major valuation models. So the first valuation model is cost to duplicate, and as the name suggests, in this particular approach, what happens is that the the investor, they try to come up with a cost what it will take to duplicate your business or your product or the service which you're working on. So essentially what they're working on, or what they work on, is they try to come up with a cost to build another business or another product or another service which you are working on from the scratch, and then they come up with the value for your business as the value what they have derived in terms of going through that exercise. So it is more like the lowest kind of the estimate for valuing any business. And usually the investors, they usually use it as a lowball estimate as far as your overall business valuation is concerned. Of course, I mean, it has other challenges as well, especially it doesn't look at the overall potential of the business or of the product or the service which you are developing. So it almost ignores that very important point as far as your startup is concerned. The the second one is the market multiple approach. So the market multiple approach is nothing but the investors, what they try to do is they try to arrive at a value of your organization, looking at any recent acquisitions or any recent transactions which has happened in the market for the companies which are similar to yours, or a product or a service line which you are working on similar to your product or your service line. So essentially it's kind of a a quick valuation where they look at the similar companies which are very similar to your business, and they look at how the transaction has happened, what was the multiple, whether it is 3x, 5x, 7x, 10x, and then they arrive at a valuation based on what has happened with the similar companies previously. Again, this has challenges as far as the valuation is concerned, and the challenges remain the same as we discussed in cost to duplicate. That's mainly around the potential of your business, or the way you are trying to solve any business problem. It might be very different from what they might be looking at as a similar company. So that's number one. And the second major challenge with this particular approach is that most of the time the information is actually not available in public because of the confidentiality reason, in terms of what were the deal terms for the similar company, or what exactly was the multiple for that kind of evaluation. So again, this particular approach also has a lot of challenges. The third approach, which we are also going to cover in this particular presentation, is the discounted cash flow approach. So essentially, what this particular approach or evaluation model looks at is that it is trying to calculate the value of your business based on the future value or the future cash flows which you are going to generate, and discount it back to the present value. So essentially, what it does is that it calculates the present value of your expected future cash flows by using a discount rate. Now, what discount rate is? Of course, we will be covering it in the subsequent slide. But the discount rate is nothing but a rate of return or an opportunity cost for the investor that he could earn if he would have invested in market on a similar kind of an investment in terms of risk, in terms of the overall size of the investment. So this is one of the widely used valuation models for businesses who are running for a long period. They have historical data in terms of sales, operating expenses. So it works very well as far as the valuation for those kind of businesses are concerned, but it is also used very often for valuing the startups as well. Now, one of the challenges, of course, is again the forecasting and the assumptions which you are making while creating your forecast figures or your income statements. Again, we will go through those in the subsequent slide in terms of how we are calculating it. But yes, it is one of the challenges which is being faced when taking into account this specific valuation model or an approach. And the last valuation model or the approach is the valuation by stage. So essentially, in this particular approach, the VCs or the angels or any other investor, what they do is that they have their own set of rules in terms of depending on the stage where your business is. So whether it is pre-seed, seed, Series A, or whether your product is in development, or it is already MVP, or it is already in business generating X amount of revenue. So they have preset valuation ranges for depending on the stage your business is, and they come up with a valuation for your business depending on the stage where your business is. So essentially, the investor or a VC or any such organization who's valuing your business, they usually do not rely on a single approach or on a single model, evaluation model. They usually have a combination of 2, 3 different valuation models, and that's how they come up with a range in terms of the value range for your business, which they can offer to you. In this particular presentation, as I said, I'll be mostly covering the discounted cash flow valuation model, because this is what is being used widely for the businesses, as I said, who are in business for a long time, and it is being used for a very, very long time, and it is also used. It can be used very effectively for the startups as well. So before we get onto the discounted cash flow valuation model, let's do a quick recap on the basic concepts of financial analysis. So one of the main concept in the valuation doing the discounted cash flow method is the time value of money. So essentially what it does is that it helps you calculate the equivalent amount of money for different time periods. So essentially what it helps you is that if you are generating an X amount of cash flow today, what it will be worth 2 years, 3 years, 4 years, 5 years, or any n number of years from today. And inversely, you can also calculate if you are aware or if you have forecasted your value for after 5 years, then what should be the present value of your business. So it helps you calculate the equivalent amount for different timelines, and this is a very, very powerful tool which is being used, while doing different financial analysis, not only for the startups but also for enterprises or any large financial institution. The other important concept is perpetuity. So, I mean, just from the understanding perspective, you should be aware of perpetual annuity. So, perpetual annuity is nothing but endless sequential cash flows, which you get at a set rate. So, if you're aware of a sequential cash flow which you going to get at a set rate, then you can arrive at a present value for any such investment. Now, the third important concept, which is very important, is the terminal value. Now, the terminal value assumes that the business will grow at an identified or set rate for an infinite period, and this is usually after a forecasted period in case of a valuation. So essentially what it is doing is that in this particular, when you're calculating a terminal value, you are calculating the cash flow for the subsequent year based on the growth rate which you have set or which you have identified as going to be the growth rate, divided by the discounted rate minus the terminal growth rate. So discounted rate, as I've already explained to you, it is nothing but the required rate of return or the opportunity cost, which investor may get in terms of if he invests in the market somewhere else for the similar kind of a size or a risk. So so this particular equation helps you arrive at a terminal value. Now, as you can see in this terminal value equation, there is a term used which is free cash flow. So free cash flow is nothing but it's a cash that a company generates after deducting its cash flows which are related to the operating expenses and maintaining its capital assets. However, we must remember that it excludes non-cash expenses such as depreciation costs, and it includes the capital expenditure and changes in the working capital. So we are going to see how these are being used when we are doing the calculation for arriving at a value for a specific business. So before I go to the Excel sheet of the financial summary for a hypothetical startup, I will encourage all the founders and entrepreneurs to go through the financial summary of similar companies which are publicly available. So try to find out or try to see what is the publicly available information and go through their financial summary, because it will help you understand the different financial reports and also help you analyze your business in a much more better way. After I go through the Excel sheet, which I'm going to share in this particular video, I would also encourage you to create your own Excel sheet and try to calculate the business value for your particular startup. So let me share the Excel sheet. Just a sec. So as you can see, so this is the financial summary for a hypothetical company, ABC Limited, and I have tried to create an income statement for this particular company, but you can also see over here there are various tabs over here. So what I have tried to do over here is that I have, for my own understanding, and this is what I will encourage you as a founder or an entrepreneur to have, is have a detailed, when you're talking about a revenue, like for in this particular example, the hypothetical startup sells cloud as a platform service, or they have created a product which is sold as a cloud product. And sold as a subscription, and they sell it in two different types subscription, a 12-month subscription or a 6-month subscription. So as you can see, I've created, a detailed in terms of, how the business will be done, in which markets, over a period of different quarters, over a period of multiple years. So while you are, having discussions with the investors, then they will be aware that, how you have arrived at these total revenue figures and how you have forecasted these particular revenue figures. The next important tab, which you can see over here, is the expense details, which is also related to the employee. So how you are going to hire different people. So I mean, again, you can see that there are forecasting which is done for the hiring over a period of multiple quarters or multiple years, and then accordingly you can also arrive at the expenses related to this hiring, in terms of salaries paid, in terms of all the other expenses, which are marketing and other expenses. What I have done over here is that I have done a separate sheet for various key indicators over here. So I have taken assumption of an income tax rate of 25%. A discounted rate, which I have explained, is the opportunity cost for the investor as 15%. Growth rate after 5 years for calculating the terminal value. I'll show you how it is being done at 4%, and depreciation at 10%. So you can see that I have arrived at a earnings before tax and before interest and tax, and then earnings before interest but after tax. I also, for this particular hypothetical startup, I've also done calculations related to investments which are made in property and equipment. Also the accumulated depreciation, and also the capital expenditure for each year, forecasted up to 5 years, and then also a change in the net working capital over a period of the next 5 years. So this is how we are going to come up with the value for a specific startup. So as you would remember, that I covered a few concepts: time value of money, terminal value. So essentially what we are doing over here is that we are trying to first calculate the free cash flow for the firm. So if you remember, what we covered in the previous slide was free cash flow was the cash which a company generates after deducting the cash outflows. So it excludes the non-cash expenses, but it includes the capital expenditure and changes in the net working capital. So over here, if you see, I have taken the earnings before interest and after tax, and this includes depreciation, as you can see over here. So what I have done is I have added back the depreciation, because this is a non-cash expense. So we have added back the depreciation over here, and the change in the working capital and capital expenditure we have deducted from the figures which we have taken into account for each year. So doing this, we have arrived at a free cash flow to the firm for each year, and you can see that we have arrived at these figures up to the 5th year of the forecasting figures. Now, what is this particular figure? So this particular figure, if you remember, is the value of business in terms of the terminal growth rate. So we, as you would remember, that we had the terminal growth rate of 4%. So we have calculated the subsequent year free cash flow figure using that particular growth rate. Now, once you have done that, then you have to arrive at the terminal value of this particular firm in the year 5. So we know that, okay, this is the free cash flow which the company is generating, but what is the terminal value of this particular organization from after the end of year 5? So if you remember, in the terminal value, we have the equation over here, which is free cash flow multiplied by 1 plus the growth rate, terminal growth rate, divided by the discounted rate minus the terminal growth rate. So essentially, free cash flow times 1 plus G is nothing but the subsequent year value of the organization. And then we have divided it by the discounted rate minus the terminal growth rate. So once we do that, we arrive at a figure of $62.83 million. Well, all these figures are in $1,000. So we arrive at a figure of $62.83 million. Now we need to calculate this particular figure and this particular figure. So if we add this and this is somewhere close to around 69.5 million dollars. But this is the year 5 value. So we have to discount it back to the present value. So to arrive at this, to arrive at to arrive at the figure back to the year 1, what we have to do, you remember, we have the time value of money concept. So we add these two figures and we divide it by the discount rate plus 1 to the power 5, which is for the 5 years. And once you do that, you arrive at a figure which is, so this is the figure of your organization, depending on the forecasting you have done. And this is a kind of a figure which you can use it as a first or as a baseline for negotiation with the investors, or with the VCs or any such individual or organization. Now, what is very important is that you must understand this entire valuation exercise, also your entire income statement, so that you yourself can analyze further in case of if any of these indicators change, or if any of these forecasting changes in terms of your sales, in terms of your expenses, or in terms of your capital expenditure, or anything like that, then you yourself can analyze further as a business what you have to do next, in terms of to be on path to be successful. So yeah, I mean, essentially what I have tried to do over here is to come up with a short video to help you understand how you can value your business, and how you can develop your own valuation sheet. And this will not only help you speak with or have discussions with the investors or VCs, but also help you understand your business in a much more better way. If you have any questions, you can always write to me at sgurk.ext@gmail.com, or this is my mobile number as well. I'll be happy to help. As much information as I can give, I'll definitely be able to help you. So thanks a lot, and I look forward to speaking with you guys soon.